Hi, and welcome to Money Mastery with Dee Dee. Today we are talking about taxes when you sell your home. If you've sold your home, turned it into money, I know it's $1 bills. It's my origami folding money. But if you sell your home and you have a gain, you might need to pay taxes on that. So let's talk about the situations where you may or you may not owe taxes and some other things you could do to control that tax burden, if you will. So a little basics on taxes. If you buy an asset and you sell it later for more than you paid, you've realized a gain. And typically that gain is taxed. For example, you buy a stock at $1,000, sell it for $1,500. That $500 gain is called a capital gain and you're taxed on it. Now, what's interesting and what's built into the IRS tax code is it's not quite the same on your house. There's a big capital gains tax exclusion. Some call it a loophole. Other folks call it, protect your interests sort of situation. And it's going to apply to a lot of folks. A lot of special rules, only primary homes. We're going to get into all of these, but the key is that there's an exclusion. So let's imagine for a moment, you just put your house on the market, and right now, houses are selling very quickly, often for more than asking price. The offers are rolling in, and you're wondering if you're going to go owe taxes. And the short answer is maybe. Every time you ask a financial advisor or attorney, it's always, it depends. Well, this is a big area of it depends. So this exclusion is called the home sale gain exclusion on your primary residence. And basically, it allows sellers who file joint tax returns to exclude as much as $500,000 in capital gains from taxation, or single filers to exclude half that, or $250,000 on the sale of a primary home. All these words are really important. We're going to walk through them. Now, to qualify as your primary home, you will need to have lived there for at least 2 of the preceding 5 years. So 2 out of the last 5. You must have owned the home for at least 2 of the last 5. Now, they don't have to be the same chunks of time. You can own it for a part, live in it for a part, as long as in the last 5 years, you lived there for 2 years and you owned it for 2 years. I don't know. Use your imagination on how that would work. And you cannot have you claimed the exclusion on another home within the last 2 years. So if you do this right, and really amazing, you can do it every 2 years and exclude gains. That's a lot of moving parts, but maybe a home flipper could pull that off. And let's see what this means. Imagine, let's make this a little easier. You bought your house 10 years ago, spent $300,000 on it, and you're married. You wouldn't need to pay a penny in capital gains tax unless your net proceeds from the sale are higher than $800,000. So the sale of it is $800,000. What you paid for it was $300,000. The gain is $500,000. That is excluded. Kind of nice. And honestly, most folks fall into that category. But we're going to continue to talk about ways we can manage this down and what makes up the cost basis. What is cost basis? Cost basis is what the amount you pay to acquire an asset, including any acquisition costs and capital improvements. So say you bought your $200,000 house and also had $5,000 in origination fees and other expenses. You can look at your closing statement for those. That means your cost basis is $205,000. And over time, you've made improvements, not just painted, that's maintenance, but you've made improvements. You did an addition, you totally rehabbed the kitchen. Those costs increase your cost basis, which later on down the road can reduce your taxes. So what you paid for it with the origination costs, how much you've invested in that home over the years, all added up together is cost basis. That's why when you talk to your accountant or financial advisor, they tell you to save the receipts when you're doing home improvement projects. This is why. Now, the flip side of that is what are your proceeds? What did you sell it for? So you may sell it for $400,000, but you've probably paid a real estate commission in the neighborhood of $25,000, bringing your net proceeds to $375,000. So you've got to look at both sides of the equation. Now, there are very specific lists of what can and cannot be included in your cost basis. IRS has a Pub 523 if you want to go read that, or if you can't sleep and you need something to help you sleep. Anyway, but be sure to remember these things work in your benefit. The cost that you can track related to your improvements, and the costs related to the sale both improve your situation in terms of your tax burden. So, how much is capital gains tax? Well, capital gains come in two flavors. Well, kind of three. One being the excluded kind, which is zero. Short-term capital gains is anytime you buy an asset and sell it within a year and there's a gain. Those are taxed at ordinary income tax rates, whatever you're earning on your wages these days. As you can imagine, most houses don't fall into the short-term capital gains rates. They're going to be in the long-term rates because, we move in, we live for a while, and it's more than a year. So so you know that. Now, what does that mean? So right now we have sort of I think, a strange structure on the capital gains rates. They don't lockstep with the ordinary income tax rates. They change a little bit. There's a beginning category that if you had no other income and you're married, the first $80,000 of your gain is exempt from capital gains tax. It's a 0% tax rate. So if you manage your life such that you have no other income and you sell your house that year, you can actually bump your exclusion from $500,000 to $580,000. Now, I can't for a minute imagine how someone could do that, but I presume that somewhere someone can figure that out. For single people, that threshold is $40,000. So there's a small chunk at the beginning of zero tax on the capital gains, but very hard to take much advantage of that, especially in a year when you're selling a home. Most folks will fall into the 15% long-term capital gains rates, and that's basically income up to around $500,000, be you single, married, or head of household. Married filing separately gets penalized. It only goes up to $250,000. After that, long-term capital gains are taxed at 20%, anything over about $450,000, $500,000. So it is preferential. Ordinary income tax rates compared to that are 22, 25, and up from there. And as always, they're changing. So keep an eye on that stuff. I'm not going to bore you with how to calculate this. This is something, if you find yourself in this situation, get with an advisor, get with a CPA, ask the questions so you know what's going on. I will remind you that you need to know when these taxes are due. And generally, they won't be due until the date your taxes are due for the year in which the property was sold. So if you sell it in April, the taxes aren't necessarily due until April of 2021. Taxes are due to April 2022. Now, one thing I would caution you on, depending on your income and other tax situations, you may need to make some estimated tax payments, or you can even up your withholding at work to cover this so that you can spread the cost out over the year. Now, you may ask, what happens if I sell an investment property or vacation home? Well, by definition, a pure investment property is not your primary residence. However, there may be an ability to establish a vacation home as a primary residence and gain some of that exclusion. But if you've been renting out that house, remember that you've probably been taking depreciation. When you sell a property on which you previously taken depreciation, there's a tax that recaptures the depreciation, and it's taxed at a flat rate of 25%. So say you had a $400,000 vacation home over the years, you've taken $100,000 in depreciation, but you're going to sell it for $1 million or something. You're going to have to pay a 25% flat tax on that $100,000 depreciation, separate from this other discussion of capital gains. So depreciation is its own animal. I want to bring that up because more and more folks working from home, home-based businesses, etc. When you have a home-based business and you're not using the safe harbor clause, you're probably taking depreciation, and upon the sale of your home, you're going to have that depreciation recapture issue. So keep that in mind. Another way to avoid capital gains tax, if it's not a primary home, you can look at a 1031 exchange. That kicks the tax bill down the road. Can work out very, very nicely if you want to stay in real estate. If you need to get out, it's time to get out. Another strategy you might try is tax loss harvesting. So if you've got a sale in this year and you have other investments that have a loss, this might be a great time to sell and take the loss and offset it against the gains to bring more of the capital gains into the lower tax brackets. And one interesting strategy that someone came up with in order to avoid capital gains tax on your home is, well, don't sell the house. Don't ever sell. If you stay in the house until you pass, the house passes to your heirs, and under current tax law, they get a step up in basis to the market value on your date of death. So lots of different strategies, depends on what's important for you. The key thing here, hopefully I've communicated to you that this is kind of a complex area, and there's different variables that are going to change for almost every one of you out there. If you find yourself anticipating a sale or have experienced a sale and you want to really understand what's going to happen, get with an expert. We can help you here. You may have someone that you trust in your life. Reach out and get that help because it's out there. We want to help you out. So this has been Dee Dee with Money Mastery with Dee Dee and Innovative Financial. Thank you for joining us today. Hope we've helped. And if you're moving, good luck and bon voyage.